Simon. Thanks for joining the program. So I want to start with your background, and you have a degree in physics and you have training in philosophy. So could you tell us how did you get from there to where you are now, and how did your background help in your investment career?
Sure, absolutely. I began my investment career in 2008, and at that time it was before we had terms like data science or even a lot of financial mathematics degrees. So typically hedge funds and banks were employing people from sciences directly from physics. So that part is not such a mystery. The philosophy part is more interesting because there isn't, I guess, a direct connection with what I do now. But certainly some of the skills about thinking about the strengths and weaknesses of different arguments and thinking about things from first principles are always very helpful.
So could you please describe the core strengths of Winton's strategy and how you adapt to the evolving environment?
Absolutely. So there are many features of Winton's strategies which give it important strengths. And one of the main ones is the diversification, because we trade a lot of different assets and different asset classes. And so we are able to generate profits across different kinds of market environments. That's one benefit. Another key feature is the fact that our strategies are automated. So they don't make emotional decisions about how to trade in the way that discretionary traders do. They're more rational in how they operate. And a third feature that's very important is that Winton's strategies are backed by 27 years of experience operating in these markets and by one of the largest and most impressive research teams in the industry.
Okay, so you mentioned that all your strategy are automated. And I think nowadays, one question that puzzles lots of quant investors is when should you step in, especially since the major correction in 2020. So do you think you need to incorporate all macro research into your strategy nowadays?
There's an interesting question about when you should step in, and there certainly are some occasions. The occasion when you should step in is when something happens which has never been seen before in the backtest. But 2020 was not really an example of that. In 2020, we saw a very big market correction because of COVID, but our backtests go back to the 1970s, and there have been many market corrections and many market crashes in that period of time. The 1987 crash, the 2008 financial crisis, obviously, the tech bubble, and many of those are much bigger than what happened in the case of COVID in 2020. So there's no particular reason why you have to intervene in that case.
Okay, so next we get to CTA. Winton has been a pioneer of the CTA strategy for for multiple decades. And could you elaborate Winton's experience in investment management of CTA strategies? And so how does the current macro environment drive the performance of trend following?
Yes, well, there's kind of two different questions in there. So one is about Winton's historical experience, which, like I said before, goes back many decades. And in fact, our founder had run a firm previously for 10 years prior to Winton's founding. So he has more than 40 years experience doing this. So that's the origin of of the depth of our experience. The current macro environment is very interesting, and it's a bit different from what we've seen perhaps in the decade after the financial crisis. That was a period of time which was dominated by people looking at what central banks were doing. And a lot of people thought of every asset in the world as either a risk-on asset or a risk-off asset. And they would trade based on that, and then whether they perceived central banks to be dovish or hawkish at any given moment. But since 2020, that has really changed. And instead of just looking at central banks, there have been many, many different events that have driven markets. First, obviously, the COVID crisis that took place in 2020. But since then, also the war in Ukraine, the return of inflation in most parts of the world, deglobalization, and all of these things affecting different countries in different ways. And so we've got very many more things driving markets now in a much more interesting macro situation.
So how does the macro factors you just mentioned affect trend following?
They affect it very positively because they create many different reasons why markets can trend. We saw, for example, just this year, a very, very big trend in the cocoa market. That's unrelated to everything else that was really going on in the world. And when you have this situation where many different macro markets are trending for different reasons, that's a very good environment for a trend following strategy.
Okay, so and CTA is also known for like provide crisis protection for investors, and it has been quite attractive for investors since the 2008 global financial crisis. And so a similar trend has been observed that many institutional investors tend to place a higher allocation on CTA strategy nowadays. Could you please explain how the current situation differs from the post-financial crisis period?
Absolutely. I mean, the history is interesting. So it's definitely true, as you said, that people looked at the performance in 2008 and thought that this is something that can provide help when other risk assets are doing badly. And that's really where the term crisis alpha came from. It's not a term that we particularly like because the property of doing well in those periods is only true statistically. It's not guaranteed to perform well. But nevertheless, it has performed well in years like 2008, in things like the tech bubble crash and so on prior to that. What has changed recently has been around the performance in 2022 and the behavior in particular of fixed income and equities since really the COVID crisis. We had a period of 20 years where the correlation between bonds and stocks was negative. And at the same time, from 2009, both bonds and stocks performed extremely well. And as a result, at least in the global markets, if you just held a long-only portfolio of stocks and bonds, then you had a high Sharpe ratio, almost like a hedge fund. What has changed recently is that in 2022, both stocks and bonds fell together. And also, since 2020, the correlation between stocks and bonds has flipped, and it's now positive. And the result of those two things is that just holding stocks and bonds by themselves is not such a great investment anymore as it used to be. And the case for something different, something genuinely diversifying, is even stronger than perhaps it ever was. Now, you combine that with what happened in that year, 2022, when stocks and bonds both fell. That was a fantastic year for CTA strategies. So that really cements the idea that CTAs can fulfill this role as a diversifier.
And given the macro uncertainties we are facing, could you identify a couple of macro factors you think are really important for the performance of CTA?
Well, it's very hard to say in general in the future what's going to be important. One of the key things we've learned over the years is that we have no way to know which markets are going to trend next. I already mentioned that the cocoa market has been a big contributor this year and last year, but nobody really could have predicted 2 years ago that it was going to be cocoa that was important. That's why it's so important to maintain a very diversified collection of exposures so that wherever a trend appears, we are able to take advantage of it.
The last question, given the changing environment and how people do investment nowadays, do you think you should change the time frame of how you do trend following?
Well, the time frame of our trend strategy is actually one of the things that we've researched very intensively, not just recently, but actually really from the beginning of Winton. It's one of the key parameters of the strategy. When you say you want to trade a trend, do you mean a market that has trended over the last week, the last month, the last 3 months, or longer? And it's very important to get that right. What we've seen is that over time, it's been better to be gradually slower and slower. And it's different to what you usually hear about investment, that, for example, the pace at which information has absorbed into markets, people usually say has got faster and faster. And people often talk about hedge funds as being in an arms race for technology to access markets quicker and quicker. And that may be true in general, but in the case of trend following, the opposite is true. In fact, in the 1970s and the 1980s, the faster models did extremely well. And in the 1990s, they were still doing extremely well. And what we've seen is that since then, they have got worse and worse. And in around 2007, we made the decision that we should slow our models down because we observed this happening. And that has been a great decision. It's been one of the main reasons for our outperformance over the industry for the last 20 years.